So it's going to be very important to know that in a new cycle, you need to focus on new leadership, and that leadership is going to be commodity led.
Mhm. Well, David, that's another, question I wanted to run by you is this idea that, you know, a lot of the bull run in gold has been pointed as being driven by central bank buying over the last, 4 or 5 years. This theme doesn't seem to be slowing. So how does, you know, obviously in a big liquidity crunch, everything goes down because of margin calls, anything that is liquid gets sold. But how do you think the price of gold gets affected in a time like that because of those, large institutional buyers that have been consistently and constantly driving that price?
Yeah, they'll certainly soften the blow. That's why I say, you might have a 6,000, 4,000. I'm not saying that's the right number, but
Yeah.
that's obviously a 33% drop, as opposed to an 80% drop in the stock market, or maybe a 70% drop in silver. You
Yeah.
know, so that will be a softening effect that will certainly ameliorate some of the decline. But if we're in deflation and the world's falling apart, there's going to be plenty of rethinking gold and saying, well, you don't earn anything. Gold doesn't pay a dividend, doesn't pay interest, doesn't do anything. There's a lot less demand for gold other than monetarily, other than for safety or security. And I'm not sure that's going to hold up here. You've seen it before. I mean, the thinking all of a sudden changes. So the central banks won't be so anxious to do that. Um, the dollar moving up during the bust will mean there won't be so much focus on what the alternative needs to be. What do I need to own against the fiat currency? So there'll be lots of reasons for selling it, along with what you said, which is you sell what you can.
Mhm.
Um, so I think it's not going to hold up as a in whole, it may outperform, but it's not going to hold up in a bust, particularly a deflationary bust.
Mhm.
But it will be certainly one of the assets on the other side of the bust.
Yeah, it might be. So would it be better to be in cash at that point and then rebuy gold, or does gold pull back the least in your mind through
Yeah, it
that
would.
time?
Everybody has to kind of decide what makes sense for them. But
Yeah.
certainly from a mathematical standpoint, my guess would be that cash, basically, if you've got most assets falling, cash without any gains but just no losses is a huge thing. And like I said, as long as you have your money spread, so that you don't lose that cash, cash would seem to make a lot of sense. Treasuries would make even more sense because as long as the government has a printing press, as long as the Fed still has its printing press, um, you pretty much don't have to worry about defaults on U.S. Treasuries. I can't say the same thing in other countries because I don't know exactly. The
Mhm.
likelihood is that's probably true elsewhere too. That money's it's going to be like 2008, 9. As long as there's a printing press, the sovereign debt isn't at risk, right?
Yeah.
The problem we have is going to be when you skip over to the other side of the recovery cycle. If inflation moves up to 20 or 25% in this country, if interest rates follow that as they do, there's a good chance that T bills will be. And I was a, a money manager back in 1981 and 2. There's a good chance that treasury bills will be over 20%. There's a good chance that the long bond will be somewhere between 15 and 20%. And we'll have twice, probably twice the debt we have today to service. That equation doesn't get solved, right? You're bankrupt. The government won't have enough revenue to even pay the interest on the debt.
Mhm.
Never mind fund military, fund welfare, et cetera. somewhere along the line, as we approach the end of this decade, we cross over at that place where, because early on they'll be printing more money to and selling more bonds to help fund their needs. But as that fuels more inflation and rates move up faster than they can keep up with it, you cross over a point where that makes sense, because the more you print, the more you owe, or the more you can't keep up with it. So there is a point, I think, late this decade where we cross over, and the reality is we've lived way beyond our means. We no longer have a way to allow that. The printing press is closed down. You can't print money because it just is like pouring gas on a forest fire.
Yeah.
And so once that happens, the game's over. The Ponzi scheme has ended. And I think then it's a matter of time. You might be able to kind of take from Peter to pay Paul for a little while, et cetera. But I think by the time you get to somewhere between 2033 and 35, you have a collapse of the system. Not just the U.S., but around the world, because we all have done it.
Mhm.
It's been one huge Ponzi scheme that started post-Depression, post-Great Depression, and built up slowly early on. But we're now, the Ponzi scheme's gone parabolic, right? we're racing ahead in terms of our debt numbers and all of that at levels we never saw before. So that's a sign that you're going to burn that whole thing out. And it's like it's like watching a parabolic stock. When it reaches its crescendo and rolls over, it goes down almost as fast as it went up.
Yeah. So David, when we see the strength in the metals at that time, what do you think happens to the mining stocks, the precious metals mining stocks?
I think they are going to be huge winners.
Mhm.
I think the post bust era, you're going to see lots of money made. It will be the dot-com stocks of the early 2000s. It will be the AI stocks of today. Mining stocks will be big, big winners, as will a lot of, oil exploration stocks, et cetera. It's the need for materials, commodities, means that prices are going to go through the roof.
So David, before we kind of move on here, can you give us a quick refresher of, let's say, your GDX, your gold, energy targets, all of the targets for this, let's say, this intermediate top here?
Yes. So for I'll start with gold. My GDX and GDXJ targets, those are the miners and the junior miners. I did raise targets there twice in October. My early October letter. I raised GDX from 75, I think it was, or maybe it's 65, up to trying to think, 120. I raised GDXJ from 100 up to 170. And then in my January letter, I raised those from there from 120 to 150 for GDX, and from 170 to 210 on GDXJ. So that's where I'm at now. On silver, SIL, which is large miners, major miners, it was 75, and last October I raised it to 150, and then I raised it to I'm trying to think, 180, I think, is my current target. Um, and for SILJ, which I had a long held target of 35, and it was 10 a year ago. It was people going, no, I think that target's going to be hard to reach. Um, I raised it in October from 35 to 60. And, these are big changes, because I don't normally,
Mm-hmm.
I'm looking ahead, but that was, I had fortunately, I did see things that told me even as far away as I was, that I needed to go higher. So I raised 60, and then I raised it again in January to 75. So
Mhm.
that's where I'm at now. In terms of oil, I don't really expect oil to do anything but kind of trade in a range till the bust hits. So my real focus, I've been saying target is trading ranges, low 50s to 65 or mid 60s. Um, in the bust, as I said, 30 or below. Um, Post bust, or and so um, for XLE, the ETF for oil stocks, the only target I have is, um, it was $20, but they split it 2 for 1, so it's $10 for XLE in the bust, and that I think the stock is somewhere up in the high 40s maybe. Um, so that's a big drop. And then coming out, I don't have post bust numbers, but those things will all go up a lot. Copper, as I said, my copper target currently is $8. I have a target for COPX, which is copper producers. Had been, I think, 75, and I raised it to 100 last October, and now it's at 120. So, still good upside there, I think.
Mhm.
Any others? I think that's pretty much it. Um, Trying to think if there are any other ETFs that really are
We've
important.
we've kind of covered, let's say those are the upside targets here. Do you see, is this a roundabout, let's say 30 to 50% pullback in many of those numbers that you mentioned,
Um,
in that initial bust?
no, in the bust, I don't have different phases of the bust, but in the bust, if the market's going down 80%,
Well, let's say
cyclical stocks are
after that
cyclical stocks.
intermediate top, sorry. That's what I mean.
Those are my tops for those are the pre-bust tops. So before
Right.
we start going down, those are our peaks. Um, and in the bust, where I think the market's going to go down 80%, I presume these things will go down pretty close to that. They're cyclical stocks. Um, their prices are going to get hit, et cetera. I will tell you, just to give you an idea, we've had tremendous runs, and everybody says the miners have lagged. Yeah, they've lagged because silver's done so much and gold's done very well, but they've come up. In many cases, they're up threefold or more in the last year. Um, so I am calling for, and I don't usually try to short term it, but I think this is a big enough correction. I think we're very close, and I haven't seen what silver's doing today, but I think we're very close to a short term top, um, where we could have a 20 to 30% correction in the price of silver. And that's a big hit. So if it can do that just in a correction, imagine what it can do in a bust. So
Right.
same thing with the miners. I think the miners can come down maybe 25%, in a correction. So if they can do that in just a correction, and by the way, that correction means we have another leg up from there. So silver, my target 125 now, is going to have to be raised, I think, at some point. Um, but I'll probably do it in during the correction. I want to see what things look like during the correction. But for sure, I think I'm going to have to raise both gold and silver targets, and not sure about the miners,
What are
because
those
they're
what are those targets now?
silver is 125. So you know, I would guess I'm probably going to be raising it by 40 or $50 maybe, but I don't know that yet. I really want to see. Um, and then gold is 5,500. Uh, I wouldn't be surprised if I had to raise that. It's almost at 5,500 now. If we get a correction in gold, silver, like I said, could correct as much as 30%. Gold, I would guess, probably corrects 10 or a little more. So, if gold's 5,500 at the top, because I think we're very close, whether it's this week or early next week, I think we're within days of a top probably, or certainly a week of a top week and a half, um, or less. If gold tops near 5,500, it can probably come back. I'm trying to. It might even do more than 10, but certainly something in the high fours would make sense. So it's not going to get hit as hard as silver by any means in a correction, and then come out of that and probably go to higher highs for both metals.
Mhm. So, David, once we get that, let's say that bust or that in some ways that global reset, does are you optimistic? Does life look something like a good thing after that?
I think we're late in it. What I call a super cycle is a long cycle between two depressions. So the Great Depression of the 1930s and what I think will be an even greater depression in the 20 mid 2030s and beyond.
Mhm.
So if I'm saying that that's what we're headed for, I'm not optimistic about our future 10 years out. I do think there are great opportunities post bust, and what I tell everybody is your fighting chance in what's coming, I think, is to get your financial house in order first going into the bust. Make sure you don't ride it all the way back down. Um, you know, Clean up any debt you can, and then come out the other side. And if you invest properly, there's certainly things that are going to be 5 and 10 baggers in stocks, and for even the average investor, you're going to be able to, coming out of the bottom of the bust, you're going to be able to make 3 or 4 times your money in mutual funds or anything, ETFs, I should say. Um, but if you write it down, you're just trying to get your money back. If you've actually protected your capital, there's an opportunity to get your house in order and give you a fighting chance. What I describe in terms of what comes after the recovery cycle that follows the bust is we're going to have, if I'm right, um, no money for welfare, no money for unemployment, no money or limited, if at all limited. Social Security bankrupt, Medicare very, very limited, if at all. Medicaid. You're just not going to have the support system that everybody's grown up on, and that means everybody's fending for themselves. That's not I can't pretend to envision exactly what that means, but it doesn't speak to me to something that's going to be friendly. I mean, it's there's going to be crime's going to go up big time. Violence probably going to go up big time as people fight for survival. I hope I'm wrong. I hope a lot of what Trump is doing cleans up a lot of the debt, and that somehow the world gets its act together, and we can kick the can down the road for lots more cycles. I just have my doubts.
Mhm. David, is there anything that we haven't covered? Maybe, something on your mind that, let's say, you don't get asked too often. Um,
Yeah, I'll
it,
say that the thing we have not covered is bonds, and I think obviously rates are ticking up here again today. I think we're very close. Bonds are putting in a 2 year bottom. Basically, have been they came down prior to that 2 years, but they were basically been in a very rounding bottom here, kind of flat trading area for a couple of years, tight trading range. I think what we're going to see is we emerge from this on the upside in terms of bonds and on the downside in terms of rates. I think rates during this last, whether it's 3 months, 4 months, 5 months, I don't know, but during this last run in the stock market, I think rates coming down are going to be part of what drives it. So you're going to have lower inflation, lower rates, an economy that is still holding together, maybe maybe more than that based on what we see right now, but at least holding together. No, you're going to hear no recession, et cetera. Um, and that's what I think drives this last move in the stock market. A big part of it will be, I think the 10-year can drop from, we're currently 4.25. It can drop to 3% in this next, 3, 4, 5 months. I think probably more like 5 or 6 months. But if you can move from 4.25 to 3%, that's a lot of tailwind for the
Mm.
market. And then if I'm right at all about, second half of this year, later in the year, sometime, this thing rolling over, the market peaking, and then the economy rolling over, and it's starting to pick up speed. During the bust is when rates can fall from whether it's 2.5, 3%. When that really gets going, I think you could see a 10-year at zero. So a 0% 10-year, and again, people go, that's impossible. Who's going to buy? The Fed's going to be buying up every bond they can find to do QE of that magnitude. Institutions are going to be buying for safety and saying we may not earn much, but we can't afford to lose, so we're going to buy treasuries. And short rates are probably going to be negative, so they'll be happy to have zero, and the 30-year might be selling at a quarter or half percent yield. But in a deflationary environment, that's money. Um, so I think the bond market that everybody's been so anxious about may finally turn the corner here pretty soon, and be part of the wind at her back.
David, there's been an idea kind of thrown around here, and obviously not officially, but an idea that if the Treasury and the Fed instituted a gold-backed bond of some sort, that would or could spur more demand for that. Do you think that that's a possibility or something that could happen?
Yeah, I struggle with the things because Trump certainly is willing to do things we've never done before,
Mm.
and they're thinking about trying to solve. They're problem solvers, I think, more than we've had in the past. So stable coin, um, gold back bond, etc. I just don't think it's you can do anything in a magnitude that's going to offset what our problem is. So
Yeah.
I think it can temporarily cause some excitement and cause things to hold up beyond what I might expect.
Mhm.
But ultimately, I think the numbers are just too huge. I mean, this has been 90 or 100 years in the making, and we're at levels where, again, this isn't the cycle where I worry about sovereign debt, but think about when the printing press goes away and most of that debt out there that we quote 330 trillion, the biggest part of that increase is sovereign debt in this cycle, certainly. Um, when they reach the point where they can't service that, there's nothing out there you can do, I don't think, to offset that kind of magnitude.
Mhm.
We throw around trillions today, but hundreds of trillions is a whole different story.